In 2001, the world watched in disbelief as Enron, once hailed as a titan of the energy industry, collapsed almost overnight. The fallout was catastrophic, wiping out £7 billion of people's savings in a matter of days. For many, it wasn't just a news story. It was a personal disaster that changed their lives forever. Many employees, from junior staff to senior executives, had invested their entire pensions and retirement funds in Enron stock. They believed in the company's promise, convinced it was a sure thing, a safe bet for their future. The company's success seemed unstoppable, and few questioned the wisdom of putting all their eggs in one basket. But when the company failed, their life savings vanished in an instant. Decades of careful planning, hard work, and hope for a comfortable retirement were erased. The shock was overwhelming, leaving families and individuals facing an uncertain future, forced to rebuild from scratch. The pain wasn't just financial, it was emotional too. People lost not only their money, but also their sense of security and trust in the system. The collapse shattered the illusion that big companies are always safe and that loyalty to an employer guarantees protection. This wasn't reckless gambling or wild speculation. It was a single, devastating mistake. Putting all their money in one place, trusting that nothing could go wrong. It's a mistake anyone can make, especially when things seem to be going well. The lesson here is clear and timeless. No investment, no matter how promising, is ever truly guaranteed. Even the most successful companies can falter, and markets can change in the blink of an eye. Even today, people fall into the same trap, chasing hot stocks, betting everything on one property, or trusting a single investment to secure their future. The temptation to go all in is strong, especially when everyone else seems to be winning. The Enron story is a brutal reminder. If you don't spread your money around, you risk losing it all. One unexpected event can set off a chain reaction, toppling everything you've built. Protecting your wealth isn't about being a financial genius or making risky bets. It's about using simple, time-tested safety measures, like diversification, planning, and asking questions before you invest. The first step to real financial security is making sure that no single event, no matter how unexpected, can wipe you out. By spreading your risk and staying vigilant, you can protect your future and weather any storm. So, what's the solution to the unpredictable ups and downs of investing? The answer is diversification, a word you'll hear a lot in the world of finance, and for good reason. It might sound complicated, but at its core, diversification is just common sense. Think of the old saying, don't put all your eggs in one basket. If that basket drops, you lose everything. But if you spread your eggs across several baskets, a single mishap won't wipe you out. Instead of betting everything on one investment, you spread your money across a variety of options. This way, you're not relying on just one thing to succeed. It's about creating a safety net for your hard-earned cash. Let's make it even simpler. Imagine you're a fruit seller at a busy market. If you only sell strawberries and there's a bad harvest, you're left with empty boxes and disappointed customers. Your entire business suffers because you depended on just one fruit. But if you also offer apples, bananas, and oranges, a bad year for strawberries doesn't spell disaster. You still have other fruits to sell, keeping your business afloat and your customers happy. That's the power of not putting all your hopes in one place. In investing, diversification means owning a mix of different assets, stocks, bonds, real estate, and more, so you're not dependent on just one type of investment to do well. It's about building a portfolio that can weather different storms. In practice, this could mean buying shares in dozens or even hundreds of companies, not just one or two. That way, if one company struggles, the others can help balance things out. And you don't have to stop at stocks. You can also invest in bonds, which are like loans to governments or companies, or in property, or even in commodities like gold. Each of these investments behaves differently when the economy changes. For example, when the stock market drops, sometimes gold prices rise. Real estate might hold steady even when stocks are volatile. By mixing these, you're less likely to lose everything at once. By combining different types of investments, you're building a more stable financial foundation, one that can support you through good times and bad. It's like constructing a house with strong, varied materials instead of just one. Remember, diversification isn't about chasing the highest possible returns or making a quick fortune. It's about managing risk, protecting yourself from the unexpected, and giving your money the best chance to grow steadily over time. Think of it as your financial seatbelt. You hope you never need it, but you'd be foolish not to use it. It's a simple precaution that can make a huge difference when things get bumpy. So, if one part of your portfolio takes a hit, the others can help cushion the blow, keeping your financial journey on track and giving you peace of mind for the future. Think of diversification like a Sunday roast. The main meat is your core investment, reliable but not enough on its own. Add roast potatoes, international shares, vegetables, bonds and property, and gravy, cash savings. Each ingredient plays a role: growth, stability, and liquidity. The combination makes the meal and your portfolio balanced and satisfying. Don't just buy shares. Build a mix like a perfect roast. Some parts drive growth, others add stability, and cash ties it all together. That's how you create a resilient long-term investment plan. Your grandmother was right. Never put all your eggs in one basket. This old saying isn't just about eggs or baskets. It's a timeless lesson about risk and safety that applies to almost everything in life, especially your money. Imagine carrying all your eggs in one basket. If you trip or the basket slips from your hands, every single egg could break in an instant. All your hard work, gone in a moment. That's a lot of pressure for one basket, and for you. But if you split your eggs into several baskets, a stumble only costs you a few. You might lose one or two, but the rest are safe. This simple act of spreading out your risk can make all the difference. In investing, your eggs are your money, and the baskets are different investments, like shares, property, bonds, or even savings accounts. Each basket represents a different place where your money can grow. If you put everything into just one share or one property, a single failure can wipe you out. Markets can be unpredictable, and no investment is ever completely safe. Diversifying means spreading your money across different companies, industries, and even countries. It's about not relying on just one thing to succeed. For example, if UK shares have a bad year, your US stocks or property investments might do well. Different markets often move in different directions, so your fortunes aren't tied to just one place. The success of other baskets can help offset the losses of one. This balance is what helps your wealth grow steadily, even when some investments struggle. It's a simple, powerful way to protect your wealth and give you peace of mind. You don't have to worry about losing everything at once. Don't risk everything on one outcome. Use multiple baskets, diversify your investments, and you'll be better prepared for whatever comes your way. That's how you avoid disaster and build a safer, more resilient financial future for yourself and your family. Diversification also smooths out the ups and downs of investing. Markets are unpredictable, one day up, the next down. Watching your savings swing wildly can be stressful and lead to bad decisions. A diversified portfolio acts like a car's suspension, absorbing the bumps. Different assets perform differently at different times. When shares fall, bonds often rise, and vice versa. Owning both means gains in one area can offset losses in another. This reduces volatility, making it easier to stay invested for the long term. Diversification keeps your financial journey steady and less stressful. Diversification isn't just about safety, it's about opportunity. The next big winner could come from anywhere: the US, Asia, or a new industry. If you only invest locally, you miss out on global growth stories like Amazon or Alibaba. Different sectors boom at different times: tech, healthcare, energy. By owning a bit of everything, you always have a stake in what's growing. You don't need to predict the winner. Just own a piece of all the runners. This way, you capture growth from multiple sources. Diversification lets you benefit from progress wherever it happens. So, how do you actually diversify? Start simple. Invest in a low-cost multi-asset fund, sometimes called an all-in-one fund. It's like buying a hamper filled with different investments, global shares, bonds, property, and more. The fund manager does the hard work of mixing assets for you. With one purchase, you get instant diversification. These funds are labeled by risk level: cautious, balanced, or adventurous. Pick the one that matches your comfort zone. Many are tracker funds, keeping fees low so more of your money stays invested. Open an account, choose your fund, and start investing regularly. It's the easiest way to build a diversified portfolio from scratch. Once you've started, check you're not too focused on your home country. Most people invest where they feel comfortable, usually their own country. But the UK is only a small slice of the global market. Limiting yourself means missing out on growth elsewhere and taking on unnecessary risk. A good multi-asset fund should give you global exposure, but always check the fact sheet. If you're still too UK heavy, add a global tracker fund. Balance is key. Don't let familiarity limit your opportunities. Investing globally protects your wealth and taps into worldwide growth. If you remember one thing, let it be this: diversification is the closest thing to a free lunch in finance. It's the most effective way to reduce risk and build wealth steadily. The world's best investors use it, and it's based on simple logic. Don't risk everything on one bet. You can't predict the future, but you can prepare for it. Building wealth is a marathon, not a sprint. Diversification is your financial seatbelt and insurance policy. It lets you grow your money while protecting against disaster. Don't wait for a shock to learn this lesson. Act now. Start with a low-cost global fund and keep your portfolio balanced. Subscribe for more tips and invest wisely.